Good day, everyone. Once again, my name is Kaya Dione, and welcome to my IFRS series. I'm going to be calling it the Code IFRS, where we're going to be discussing about different IFRS, different financial reporting standards. Before we move along, please don't forget to subscribe to my channel and turn on the notification so that you can receive notifications at every point in time I upload a new standard. So we're going to be starting with the conceptual framework, which is necessary for your understanding of every other standards that we're going to be talking about going forward. In the conceptual framework, there are about 8 chapters. From the outline, we have the conceptual framework, the definition of the conceptual framework itself, and the 8 chapters of the conceptual framework, which we will discuss in brief in this episode. So let's start with the conceptual framework and why it is important. Okay, just like when you were writing your project in school, there's a chapter we refer to as the conceptual framework. So what it does is that basically the conceptual framework is like a guide, right? A guidebook or a blueprint that explains the basic ideas around financial reporting itself. It explains the basic ideas, principles, and rules for financial reporting. So, in financial reporting, conceptual framework is a system of concepts and principles that provide the basis for the development of new reporting practices and the evaluation of existing ones. So, it's like the basis upon which every standard is developed, and if we need to revise another standard, it also serves as the basis for that. The conceptual framework has 8 main chapters. The chapter 1 talks about the objective of general purpose financial reporting. Chapter 2 talks about qualitative characteristics of useful financial information. Chapter 3 talks about the financial statement and the reporting entity. Chapter 4 talks about the elements of financial statement. Chapter 5 talks about recognition and derecognition. Chapter 6 talks about measurement. Chapter 7 talks about presentation and disclosure, while Chapter 8 talks about the concept of capital and capital maintenance. Let's deep dive into each of this chapter one after the other. Starting with chapter 1, what is the objective of financial reporting? What is the purpose or what's the objective of general purpose financial reporting? According to the standard under conceptual framework, the objective of financial reporting, according to IFRS, is to provide information that is useful to present and potential investors, creditors, and other users in making decisions about providing resources to the entity. Okay, whatever information that you get by reviewing the financial statement should be helpful for assessing what the financial position of the entity is at a point in time. You want to know what is the worth of my entity, of an entity that you're reviewing at a point in time, and you should also assess how the entity is performing, that is the financial performance of the entity in terms of revenue, in terms of cost, in terms of expenses, in terms of the profit it makes at the end of a particular period. Now, moving ahead to chapter 2, where we talk about the qualitative characteristics of financial information. While other standards kind of focus more on the quantitative characteristics of the financial statement. When we say quantitative, we mean the numbers. So, take for example, IS2 is talking about how inventory should be presented, which is a number. IS16 is talking about how PPE should be presented. But what conceptual framework tries to do is that aside the quantitative features, what are the qualitative characteristics that a financial statement must embody or must represent? Now, broadly, there are two qualitative characteristics that we must look out for in a financial statement. Number one is fundamental characteristics, and secondly is the enhancing characteristics. Again, the two broad characteristics or qualitative characteristics of a financial statement or of a financial information are fundamental characteristics, secondly, enhancing characteristics. So, starting with fundamental characteristics, what do we mean by fundamental characteristics of a financial statement or of a financial information? For fundamental characteristics is also divided into two. For a financial statement, it has to be for a financial statement to be useful, it has to be relevant and must be faithfully represented, right? The two features of the fundamental characteristics of a financial information are relevance and faithful representation. Relevance and faithful representation. By relevant or by relevance, we mean that for a financial information to be relevant, that financial information must be capable of providing predictive value of an information or confirmatory value of a financial information. Financial information is relevant if through that financial information we can predict values or and we can confirm values. Now, predictive value means that an information is useful if it can help in making future forecasts, right? And information is useful if I can use it to make future forecast of the financial numbers of a company. So if I review a financial information and I can use that financial information to determine what the future revenue is going to be to a reasonable extent, that is what we refer to as predictive value of a financial information. And that is one of the characteristics, or that is one of the features of relevance, which is the fundamental characteristics of a financial statement, of a financial information. Then confirmatory value also means that uh, the financial information must be able to confirm or correct past assessment. You must be able to use it in confirming or correct past assessment. For example, when you are comparing current value to past predictions, help users to refine their forecasting method. Like we say, the two values, which is the predictive value and the confirmatory value, are connected because information that helps predict the value that helps predict the future can also confirm or adjust past belief. So for a financial information to be relevant, it must be capable of being used for predictive value and confirmatory value. We also need to mention that financial information is relevant if such information is material. Okay, so what does materiality mean? According to IFRS, information is material if omitting, misstating, or obscuring it could reasonably be expected to influence decisions that the primary users of the general purpose financial statement make on the basis of those reports. Okay, if a financial information can determine or can influence the user's decisions, we would say that the information is material. Take for example a company that is worth about 400 billion in revenue has forgotten or omitted to include a stapler of 3,000 naira that was bought sometime during the year in the financial statement. Will that omission affect the decisions of the users of the financial statement? No. So such particular statement might be regarded as, or such information might be regarded as immaterial. So, but an information is material if the omission of that particular information would influence the decisions of the users of the financial information. So that is just to further buttress relevance as a characteristics under the fundamental characteristics of financial information. The second fundamental characteristics is faithful representation. What this does is that financial reports shouldn't just tell the legal story. They need to reflect the real economic activity of the company. While I had earlier mentioned that omitting the transaction, a stapler of 3,000 naira, might not be relevant in a financial information. Faithful representation is saying that all transactions that has occurred during the year must be included in the financial information. So don't say because financial information is irrelevant, then you want to exclude it or omit it from the financial information. A financial information should be complete and unbiased. Means that the financial information must be accurate in totality and must be free from mistakes, errors, omissions as much as possible. Okay, so those are the two fundamental characteristics of a financial information: relevance and faithful representation. Now, the second broad qualitative characteristics of a financial information are enhancing characteristics, not fundamental, but now they are merely enhancing, which is also important. And enhancing characteristics is subdivided into four. We have comparability, verifiability, timeliness, and understandability. Comparability simply means that you must be able to compare two financial information together. Users must be able to compare the financial performance and position of different entities across time and even within the industries. Verifiability means that when information is verifiable, it means independent observers with sufficient knowledge can reach a consensus on whether the information accurately reflects the underlying transactions and events. So the financial information should be verifiable. Timeliness: financial information will lose its value if it's not available to users when they need to make decisions. You have to prepare and present your financial statement to the users within a stipulated period of time. And of course, the last one is that understandability. It says that even if information is relevant and faithfully represented, it won't be useful if users can't understand it. So financial information has to be presented in a way that even non-financial accountant must be able to understand it. Now, the third chapter is financial statement and the reporting entity itself. So, what this chapter just tries to do is to basically tell us what are the components of a financial statement. When you are preparing a financial statement, what are the things we want to see in a financial statement? It's talking about the statement of financial position, the statement of comprehensive income, the statement of changes in equity, the statement of cash flows, and the statement of accounting policies and notes to the account are the components of financial statement. This chapter also tries to tell us that there are different types of financial statement. We have what we call the individual financial statement, which is a financial statement of a company that does not necessarily have an associate or a joint venture or a parent or a subsidiary. We have unconsolidated financial statement, which is the financial statement of a parent company on a standalone basis. And then we have the consolidated financial statement, which is the financial statement of a parent company together with its subsidiaries and associates, which we sometimes call group account. We also need to understand that in preparing financial statement, there's an assumption that we make, which is what we call the going concern assumption. This means that financial statements are normally prepared on the assumption that the reporting entity is a going concern and will continue in operation for the foreseeable future. If there's an indication that an entity may not be able to continue for the foreseeable future, you cannot prepare a financial statement in line with the going concern. You may have to use another basis referred to as the breakup basis. But aside that, financial statement has to be prepared on a going concern assumption. Chapter 4 talks about the elements of financial statements. What this means is that for every financial information, for every transactions, you belong to one of these elements of financial statement. So there are five elements of a financial statement. We have the income, the expense, the assets, the liability, and the equity, right? Income, expense, asset, liability, equity. So when you are looking at a financial transaction, you have to make, is it an income? Is it an expense? Is it an asset? Is it a liability, or is it an equity? The first two, as you're seeing on the screen, income and expense, what they do is that they measure financial performance. They tell us what the profit is, what the revenue is. While the last three, asset, liability, and equity, tell us they measure the financial position. Okay. Each definitions are seen on the screen and according with the conceptual framework. Income basically means increase in asset or decrease in liability that result in increases in equity aside from the contribution from the equity participant, that is the shareholders, right? So expenses relate to decrease in assets or increase in liabilities that results in decrease in equity other than those relating to distributions to equity participants. Assets represent a present economic resource controlled by the entity as a result of past events. An economic resource now is a right that has the potential to produce economic benefit, right? An asset is a right, an economic resource that has given you the right, that has the potential to produce economic benefits. A liability is a present obligation of the entity to transfer an economic resource as a result of past events, while an equity is the residual interest in the assets of the entity after deducting all its liabilities. Okay, now chapter 5 talks about recognition and derecognition. Chapter 4 talks about elements of a financial statement, which are the five elements: income, expenses, asset, liabilities, and equity. At what point should we recognize them in the financial statement? Starting with recognition. Recognition is a process of capturing for inclusion in the statement of financial position or in the statement of financial performance an item that meets the definition of one of the elements. So when a particular transaction meets any of the definition of the five elements of a financial statement, at what point should we capture them or should we include them in the financial statement? The framework, conceptual framework, outlines the key criteria for recognition. So, what are the things that must occur before you can recognize them in the financial statement? There are three of them. Number one, the definition of the element is met. Be sure that the definition is met in line with the conceptual framework. Number two, it is probable that future economic benefits will flow to or from the entity. And number three, can the item be reliably measured? Right? So once these three criteria are met, then we can now start talking about recognizing them in the financial statement. All other standards, we still talk about the recognition criteria for each of the transactions. However, this is just the three broad recognition criteria to recognize the element of a financial statement. Okay. At what point do we recognize these elements, these transactions from the books? The recognition simply means the removal of all or part of a recognized asset or liability from an entity's statement of financial position when you recognize an item. So the recognition normally occurs when that item no longer meets definition of an asset of or of a liability. For an asset, the recognition normally occurs when the entity loses control of all or parts of the recognized asset. And for a liability, the recognition normally occurs when the entity no longer has a present obligation for all or parts of the recognized liability. Chapter 6 talks about measurement. Now that we've identified the five elements of a financial statement, we already know how to recognize them in the books, how to de-recognize them, how should they be measured. So there are two measurement bases of that we have in the financial statement or in the standard. We have the historical cost basis and we have the current value basis. Two measurement bases: historical cost, current value. What does historical cost mean? Historical cost measures provide monetary information about asset, liabilities, related income and expenses using information that is derived from the price of the transactions that give rise to them. So historical cost is only using the information that has to do with what has happened in the past. And unlike current value, historical cost does not reflect changes in values. When you decide to measure any element of the financial statement using the historical cost, you do not take cognizance of changes in the value of the asset. Say, for example, last year you bought a motor vehicle for 500 naira, and currently the motor car is worth 1000 naira. If you have used historical cost, you will continue to carry the asset in your book at that 500 naira, less any accumulated depreciation and impairment. You do not make changes to reflect, you do not make changes to reflect the current value. Now, the second measurement basis is the current value, and there are four different types of current value. We have the fair value, we have the value in use, we have the fulfillment value, and of course, we have the current cost. Any of these method can be used, and when used, we call them the fair value. I think the most popular of this method is the fair value, which according to IFRS 13 is a price that will be paid to that will be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. So when you use fair value, you're also referring to as the current value measurement. Now, value in use is another measurement basis under the current value. It's typically the present value of the cash flows or other economic benefit that an entity expects to derive from the use of an asset. So you can also measure an asset by determining the value in use. A typical example: if you have a car that you have decided to use for Uber, and you don't want to use the historical cost to measure the asset, you want to use the value in use. So what you can do is that determine for how long can you use this car for Uber, say 4 years. How much am I expected to make net from this car on a yearly basis? If you have determined that they are in year one, you make 1 million naira, year two, 700,000, year three, 500,000, year four, 400,000, right? What is the present value of all these cash flows? If we are able to determine the present value of all these cash flows over the 4 years, that is what we refer to as the value in use. Okay, you can also determine the value of an asset by using the value in use. Number three is the fulfillment value, and this majorly applies to liabilities. It is a present value of the cash or other economic resources that an entity expects to be obliged to transfer as it fulfills a liability. Say, for example, a country like Nigeria has pledged to transfer or to give about 50,000 barrels of oil to settle a debt in the next 2 or 3 years to come. So we need to determine what is the present value of the economic worth of those liters of oil or those barrels of oil that the country intends to give out to settle the debt. So if we can determine the present value, the current worth of those future fulfillments, then we can measure the liability at that value. And the last one is the current costs, right? You can also measure a transaction using the current cost, which is also referred to as the replacement cost. All right. Chapter 7 talks about presentation and disclosure, right? What this chapter is typically talking about is that to ensure effective communication of information and the financial statement, It is essential to present the information clearly and provide relevant disclosures. So by the time we start looking at each of the standard, we'll see the presentation and disclosures that we need to do for each standard. For instance, asset liabilities and equity should be presented in the statement of the financial position. Income and expenses should be presented in the statement of profit or loss and other comprehensive income. Accounting policies, specific assumptions, and measurement method adopted should be disclosed in the notes to the account, while and other relevant explanatory notes and breakdown of figures in the financial statement should be disclosed in the notes to the account. Again, if you pick up a financial statement, you will see all these. So these are at least the minimum presentation and disclosures that are required of a financial information. The last chapter is chapter 8, talks about the concept of capital and capital maintenance. What this chapter tries to do is that it tries to explain what capital maintenance is. Capital maintenance concept aims to prevent excessive dividend payments, particularly during the periods of rising prices. So it aims to ensure that dividends are not over distributed to shareholders, especially in terms of inflation, so that you are not doing something too much, right? You are not distributing profits to the shareholders too much, and this may have been as a result of inflation. So they try to look at it from two angles: fiscal capital maintenance and financial capital maintenance. Straight to the point. According to fiscal capital maintenance concepts, before you can determine that you have made money, that you have profit to distribute, profit is recognized only if the entity's physical or productive capacity at the end of the period is at least equal to its capacity at the beginning of the period, after accounting for or excluding any distributions or contributions from owners during the year. So aside from whatever is coming from the shareholders, if what the asset can produce at the end of the year is more than or at least equal to what it was at the beginning of the year, then we say the company has made a profit, and then you can start talking about distributing it. So you just don't talking about distributing profit as a whole. You have to look at what was the productive capacity at the beginning and what is the productive capacity at the end, right? If the end is more than the beginning or at least equal, then that is a profit for distribution under the fiscal capital maintenance. For the financial capital maintenance, this is basically saying that profit is recognized only if the financial value of the net asset at the end of the period is at least equal to the value of net assets at the beginning of the period, after accounting for or excluding distributions or contributions from the owners. Okay, so this is basically comparing the net assets of the financial state of the company at the end with the net assets at the beginning. If the net asset at the end is more or at least equal to that at the beginning, it means that then there's enough profit that we can share, that we can distribute. All right. So these are majorly the two types of capital maintenance. Thank you very much for listening to the conceptual framework. In our next standard, we'll talk more about that standard. It's majorly going to be impairment IS 36. We're going to talk about how to impair assets and what are the factors to look out for under impairment of assets. If you need further guidance, you have my number here. You can send a mail to me. Thank you very much. Please don't forget to subscribe to my channel and turn on the notification. Thank you.